on projections now. Our task here is to reverse engineer the numbers that we've got in the first stage while making the historical operating model. So here we'll be trying to analyze the trend, to project this trend and make the numbers of various line items linked together. So let's start. Let's start by trying to build the total customer base and its split of existing to new customers. So we see that the trend here is obviously upper slowing. So we let's assume that it continues to grow for the first several years, and then it starts to gradually decline here. In these scenarios, we'll try to keep the projections as simple as possible. So the churn is around 8, so let's assume it's 8, then 7, then 6, 5, and 5. Here you go. So our task here is to first of all calculate the number of customers. It's relatively easy, so we take the previous number and we multiply it by 1 plus customer growth rate minus churn this year, and here you go. So this is our total number of customers. So now we need to figure out how the dynamics works and how we can calculate existing and new customers. Here we are taking our total customer base and multiply it by 1 minus churn. Here are projecting. Then new customers would be 1 second, so it's just total number of customers minus existing customers. Here are those are our new customers. So now we see that the average trend here was around 5% growth. For the first few years, the company manages to continue to grow its average customer value per year, but then obviously it will be on the downside trend and will be gradually declining around the inflation number. So it will be around 3% in 5 years. Alright, so let's calculate the actual numbers. So plus customer growth rate. Here you go. Alright, so now we're able to calculate our projections for the total revenue. It's simply total customers. Basically, we can just take the formula and copy it across. Yeah, it's now correct. So for the cost of goods sold, we will be continuing to project by category. So professional services growth rate. Let's assume that the company manages to keep this rate on this track and a bit declining, but slowing down around 2%. So 2%, then customer support, let's make it minus 5%. So here minus 4%, minus 3%, minus 2%, 2%, and let's take it minus 2%. And for hosting expenses, obviously the company has limited potential for this optimization, and obviously they will rise in the future. So okay, let's start with minus 3% and then 0, then 1, 2, 2. Okay, so here we are, of professional services is previous year 1 plus our projection growth rate, and corporate is across. So the same formula here, and same formula here. So now here we just can simply copy the formula and calculate. Calculation is exactly the same here. Here you go. So let's move on to research and development. Let's assume the company just keeps it as it was, around 20%. Here's our assumption, and now we have to multiply our assumption by the revenue number. Here you are. So now, as for sales and marketing, let's see what the trend was. For existing customers, it was 3% growth. Let's imagine that the company is able to optimize its budget and its sales and marketing efforts, and its marketing team saying that the growth rate is optimizing over the years. Alright, so let's keep it 2%, 1, and finally it just stays the same. And growth in actually new customer marketing will be around the same trajectory, but obviously it will be much more than inflation. So for now we are using the same formula here, copying this across, and here calculating our total numbers. Okay, general and administrative. Let's assume that the trend will continue. And here it will be around 7%. Again, in corporate finance, it usually takes us a lot of time to figure out what would be the most appropriate projection assumptions of growth rate and the dynamics of various financial numbers. But our exercise is just to build a model, so we will not concentrate on these assumptions, but rather focus on technicalities. So formula is exactly the same here. And here it's just the variable expense as percentage of revenue. So we're simply multiplying by total revenue and copying this across. Okay. So for other interest rate on cash, okay, let's assume that it's constant, and effective tax rate, let's keep it the same, around 20%. Let's move on to our balance sheet assumptions. So accounts receivable, let's keep it simple and project 9%, then 10, and just 10. Inventory just 20%. Prepaid expenses 7, 6, and okay, let's keep 6. Operating liabilities, accounts payable. So let's keep it 3% constantly. Accrued expenses, alright, let's keep it 3 as well. And deferred revenue, Okay, let's assume that it's just exactly the same trend as we saw in historical numbers. So now we are moving to our capex and depreciation schedule. So in the first part, we've modeled the historical numbers and left the space for our new modeling. Okay, let's continue what we have done. But first, we will have to do the assumptions on the capex spending. So let's assume that it is held constant at 3% of revenue. Now it's simple, multiplying by revenue to get the actual number. It's 107, projecting in the future. Here you go. Alright, so annual growth rate, just copying across. Pretty solid investment in capex. Okay, so for now, let's move on and continue our depreciation schedule. So transpose, taking these 4 numbers and dividing by useful life of PP&E. Sorry. So we'll have to repeat it one more time. So Control Shift Enter. Yeah, exactly what we need. Let's move on. Here you go. Transpose. Then divide by. Okay. Control after. Okay. Then one more time. Transpose. Taking annual capex, dividing by our useful PP&E life for each new category of PP&E capex investments. So making it okay. So it's 200. Okay, so 249 now. Okay. Selecting space here, so transpose. Dividing by the useful life of new PP&E, Control Shift Enter, and just to brief you on that. So you see that the count is 7. So for this year, the first investment in property, plants and equipment that we've made on 2015 already depreciated. So here would be the blank. There would be nothing to depreciate here, and we will have to focus on the other ones. So transpose. Taking except for the first payment, first capital expenditure, to make it exactly 7, then divided by 7 years, and pressing Ctrl Shift Enter. So here you go. Here is our annual depreciation. Perfect. So total existing make PP&E, just copying it across. So and let's move on to other. Here are the simple changes over the year, simple deltas. So let's assume that it's just 0 for all these numbers, using the trends that we see here. Alright, so next we will be modeling our income statement, balance sheet and cash flow statement based on the projections that we've made here. Let's create our income statement based on the assumptions that we've just made. So it should be simple since our historical numbers are linked directly to the assumptions sections that we were creating. So we can copy this across and make the sanity check. So here you are, we can copy that across as well. Fine. Then cost of goods sold, same. Gross profit, gross margin, copying it again. It should be working. Very good. Then operating expenses linked directly, so we can copy it very well. Total expenses, total operating expenses. Alright, so our operating income, copying it. Same goes to EBIT, EBITDA margin. So here you are, copying it, pasting. That's fine. One thing on interest income and expense. So we don't have the numbers for the cash balance yet. So it would be equal 0, but the formula is correct. So we only have the cash flow number for the beginning of year 19. So it's calculated. For the rest of the years it's simply 0 because our cash flow is 0. Once we are able to insert the correct cash balance, it will be calculated automatically. So profit before tax, copying it, income tax, effective tax rate, so we can just copy that over here. Here you go. So let's move on to the balance sheet. Our task here would be a bit more complicated. So cash flow statement, cash and cash equivalents, it directly linked to cash flow statement. So we can copy that, but keep in mind that our cash flow statement is not modeled yet, so this is the same number will be here. Okay, as for accounts receivable, we will have to use our assumptions. So we were driving accounts receivable as percentage of revenue. So we're multiplying this percentage by revenue. So total revenue, here you go. Copying across, that's fine. So moving next. Our prepaid expenses. Here you go. Moving to our assumption page. Prepaid expenses as percentage of OPEX. Multiplying this percentage of to OPEX. Here you go. So seems to be correct. 222. Okay. Inventory balance. So it's obviously as percentage of cost of goods sold. So taking our projected percentage, multiplying by cost of goods sold, and here we are, and copying this across. So it's simple formula, we can copy that. Here you go. So total assets, total current assets. Let's move on to non-current assets. So this one, property, plant and equipment, is directly linked to our PP&E and depreciation schedule, so we can copy that. For long-term investments, we just adding the delta that we've made in our assumptions. So long-term investments per year, fine, it's 0, copying it. Other non-current assets, exactly the same, taking the previous number and adjusting for the delta that we've assumed. So here you go, increasing non-current assets, here you are. So it's just being held constant. So total non-current assets, it's just a formula, so we can copy that. Simple. total assets exactly the same. So we are now going to current liabilities. Accounts payable are projected as percentage of operating expenses. So we multiply our percentage by operating expenses for this year, and we getting our number. So copying it across. Accrued expenses, totally similar to accounts payable. So taking our accrued expenses balance assumption and multiplying it by total operating expenses. Here you go, projecting. Then deferred revenue, will be obviously driving it by revenue. So taking our deferred revenue assumption, multiplying it by total revenue. Here are our numbers. So it's a formula for total current liabilities, copying it. Other non-current liabilities, exactly the same that we've done with other non-current assets and long-term investments. So we're taking the previous number and adjusting it for the delta that we've assumed. So it's 0 here, so copying this across, and copying this formula. Here we are, total liabilities. It's a formula, copying it. So shareholders' equity, exactly the same. We just take our assumption. New equity issued by the company. Copying that. Retained earnings. It's a formula that is linking our previous retained earning balance to the new net income number for each year. We're assuming here that the company pays no dividends, so we can copy that. Shareholder equity just formula, and it is exactly the same. So, and we can keep our balance check. So, obviously our balance check is signaling that the balance sheet is not in balance. It's because our cash and cash equivalents items are not correct. Let's move on to the cash flow statement. Here are the simple formulas that we've inserted. So we're not making any assumptions on the cash flow statement because we're just creating it from our income statement and from our balance sheet. So we can just copy everything here and it should be fine.